Want to know the secret asset that's helped countless millionaires build unstoppable wealth? It's not stocks or crypto, it's real estate. Stick around because in this video, you'll discover why real estate could be the game changer on your journey from zero to millionaire. Welcome back to Read Glow, where we break down the smartest wealth building strategies for everyday people. Today, we're diving deep into Chapter 9 of Zero to Millionaire, exploring the powerful role real estate plays in creating lasting financial freedom. Whether you're a beginner or looking to diversify, this video will give you the insights you need to make real estate work for you. Chapter 1: Explosions and Contractions. In the opening chapter, Nicholas Berube introduces the concept of market cycles by explaining the natural fluctuations of the economy and stock market, which he terms as explosions and contractions. These cycles are inevitable and impact all investors, whether beginners or professionals. Understanding these phases is crucial for anyone aiming to build wealth through investing. Explosions refer to periods of rapid economic growth and rising stock prices. During these times, optimism is high, investment opportunities seem abundant, and many investors see quick gains. However, these phases can create overconfidence and sometimes lead to inflated asset prices, setting the stage for eventual downturns. Conversely, contractions are periods when the economy slows, stock prices fall, and fear or uncertainty dominate investor sentiment. These downturns often trigger panic selling and pessimism, but Berube argues there are also times of opportunity for those who understand the cycle. Berube stresses that instead of fearing contractions, investors should learn to embrace them as essential and predictable parts of the market's natural rhythm. He advises readers not to panic or make impulsive decisions during downturns, but to maintain a long-term perspective. The chapter also emphasizes the importance of staying calm and disciplined through market volatility. Emotional reactions to market swings often lead to poor investment choices, like selling at the bottom or buying at the top. Berube encourages readers to develop emotional resilience and trust in their investment strategy. Another key message is the value of historical context. By studying past market cycles, investors can recognize patterns and avoid common mistakes. Berube highlights that markets have always recovered from crashes, often reaching new highs, reinforcing the power of patience. Finally, the chapter sets the tone for the rest of the book by framing investing as a marathon, not a sprint. Understanding explosions and contractions and learning to navigate them wisely is fundamental to moving from zero to millionaire status. Chapter 2: Seeking the Rare Pearl. In Chapter 2, Nicholas Berube uses a metaphor of searching for a rare pearl to describe the investor's quest to find valuable and profitable investment opportunities. Just like a pearl diver who must patiently search through many oysters to find a precious gem, investors need patience, discipline, and a keen eye to identify the best stocks or assets that will lead to significant wealth growth. Berube emphasizes that not all investment opportunities are equal. Many stocks or investments might look promising at first glance, but lack the potential for long-term growth. The key is to distinguish between common, mediocre options and the rare, high-quality investments that can generate outsized returns. The chapter explains the importance of quality over quantity in investing. Instead of diversifying excessively into many average stocks, investors should focus on a smaller number of high-potential investments. This approach helps in maximizing gains while reducing unnecessary exposure to poor-performing assets. Berube also stresses the significance of due diligence, the research and analysis investors must conduct before committing their money. This involves understanding the company's business model, competitive advantage, financial health, and growth prospects. He warns against blindly following tips or popular trends without proper evaluation. Another important aspect covered is the long-term perspective needed to spot and hold on to these rare pearls. Many investors lose patience when markets fluctuate or when investments do not produce immediate returns. Berube encourages perseverance, reminding readers that valuable investments often take time to reveal their true worth. The chapter introduces the idea of value investing, buying quality stocks at prices below their intrinsic worth, as a strategy for finding rare pearls. This approach requires careful analysis and a contrarian mindset, sometimes investing when others are fearful or uninterested. Berube also touches on the psychological challenges in this search, including the temptation to chase quick profits or follow the crowd. He advocates for emotional discipline and sticking to a well-thought-out investment plan. Overall, Chapter 2 lays the foundation for the mindset and skills necessary to identify great investments amid countless options. This patient and focused approach is essential for anyone serious about building substantial wealth over time. Chapter 3, Our Fair Share of the Profits. In this chapter, Nicholas Berube focuses on the concept of earning your fair share of the profits in the investment world. He highlights that while the stock market creates enormous wealth, many individual investors struggle to capture their rightful portion due to misconceptions, impatience, or poor strategy. Berube stresses that the market is not a zero-sum game where one person's gain is another's loss. Instead, it is a wealth-creating system where investors who apply the right principles and remain disciplined can consistently grow their wealth over time. The idea is to position yourself as a patient, informed participant rather than a gambler chasing quick wins. The chapter explains that fees and taxes are significant factors that reduce investors' returns. Berube urges readers to be mindful of costs related to trading, management fees, and taxes, as these eat into profits over time. He advocates for low-cost investing strategies, such as index funds and ETFs, to maximize net gains. Another major theme is the importance of compound interest and how reinvesting profits accelerates wealth growth exponentially. Berube uses simple math to show that even modest returns, when compounded over years, can turn small investments into millions. The key is starting early and staying consistent. Berube also discusses how many investors lose money because they fail to stick with a plan. Emotional decisions like panic selling or chasing trends can wipe out gains. Instead, he recommends following a systematic, long-term strategy based on solid fundamentals rather than hype or speculation. The chapter touches on the role of dividends and passive income as another way to build wealth steadily. Reinvested dividends contribute significantly to total returns and provide a cushion during market downturns. Finally, Berube emphasizes that achieving financial success through investing is accessible to anyone willing to learn, be patient, and maintain discipline. The chapter encourages readers to stop feeling intimidated by the market and to take control by educating themselves and committing to a proven approach. Chapter 4, Stocks and Bonds. In Chapter 4, Nicholas Berube explains the fundamental building blocks of investing, stocks and bonds, and how understanding their differences is essential for any investor aiming to build wealth. Berube starts by defining what stocks are, shares representing partial ownership in a company. When you buy a stock, you essentially become a part owner, which means you can benefit from the company's profits through capital appreciation, increase in stock price, and dividends, a share of profits distributed to shareholders. Stocks are generally more volatile but offer higher potential returns over the long term. Bonds, on the other hand, are essentially loans to governments or corporations. When you purchase a bond, you are lending money in exchange for regular interest payments and the return of the principal amount at maturity. Bonds are typically considered safer than stocks, but usually offer lower returns. They serve as a way to reduce risk and provide income stability in an investment portfolio. The chapter explains the trade-offs between risk and reward when choosing how much to allocate to stocks versus bonds. Younger investors often favor stocks for growth, while older investors may shift towards bonds to preserve capital and generate income. Berube also discusses how the stock and bond markets react differently to economic conditions. Stocks tend to do well during economic expansions, but can decline during recessions, while bonds might perform better during downturns due to their fixed income nature. A critical concept introduced here is asset allocation, the process of dividing investments between stocks, bonds, and other asset classes to balance risk and return. Berube advises that proper allocation is key to managing portfolio volatility and achieving long-term goals. He also warns against trying to time the market by moving quickly in and out of stocks and bonds, emphasizing that long-term consistency beats short-term speculation. The chapter ends with practical advice on building a diversified portfolio of stocks and bonds, tailored to individual risk tolerance and investment horizon. Berube encourages readers to understand these basics before moving on to more complex investment strategies. Chapter 5. The Power of Compounding. In Chapter 5, Nicholas Berube delves into one of the most powerful concepts in investing and wealth building: compound interest. Often called the eighth wonder of the world, compounding is a process where the returns you earn generate their own returns over time, leading to exponential growth of your investment. Berube explains how compounding works by reinvesting profits, dividends, and interest instead of spending them. This reinvestment allows your investment base to grow continuously, and as the years pass, your money starts working harder for you. The chapter highlights that the time factor is crucial. Starting early dramatically increases the benefits of compounding because it allows for more cycles of growth. Even small amounts invested regularly can grow into substantial sums if given enough time. Conversely, starting late means missing out on these exponential gains, requiring larger investments or higher risks to catch up. Berube illustrates compounding with simple examples and numbers to make it easy to understand. For instance, an investment that earns 7% annually will double approximately every 10 years. Over 30 or 40 years, this growth becomes life-changing. The chapter also emphasizes the importance of patience and discipline. Since compounding takes time, it requires investors to stay the course, avoid panic during market dips, and resist the temptation to withdraw funds prematurely. Berube warns against the dangers of fees and taxes that can significantly eat into compounded returns. He encourages minimizing costs through low-fee investment options and tax-efficient accounts to maximize the compounding effect. Moreover, the chapter points out that compounding isn't just about money, but can apply to knowledge, skills, and habits, reinforcing a holistic approach to personal and financial growth. In summary, Chapter 5 teaches that compounding is a cornerstone of long-term wealth creation. By understanding and harnessing this power, investors can transform modest beginnings into millions, underscoring the book's overall message that financial success is achievable with the right knowledge and mindset. Chapter 6. The Psychology of Investing. In Chapter 6, Nicholas Berube explores the often overlooked but crucial role of psychology in investing success. He argues that mastering your mind and emotions is as important, if not more so, than mastering financial knowledge or market strategies. Berube begins by highlighting common psychological traps that investors face. These include fear and greed, which often drive irrational behavior. Fear can lead to panic selling during market downturns, locking in losses, while greed can push investors to chase hot stocks or take excessive risks at market peaks. Another key concept is confirmation bias, where investors seek information that supports their existing beliefs and ignore contrary evidence. This can result in stubbornly holding poor investments or making decisions based on flawed assumptions. Berube discusses how loss aversion, the tendency to feel the pain of losses more strongly than the joy of gains, can cause investors to hold losing positions too long or avoid risk altogether, limiting growth potential. To overcome these biases, Berube recommends developing emotional discipline and adopting a rational, long-term mindset. This includes setting clear investment goals, creating a well-thought-out plan, and sticking to it regardless of market noise or short-term volatility. The chapter also emphasizes the importance of patience and consistency. Successful investing is not about timing the market perfectly, but about steadily investing over time and weathering ups and downs without emotional interference. Berube encourages readers to educate themselves continuously to build confidence and reduce anxiety around investing decisions. Knowledge helps counteract fear and impulsiveness. Additionally, the chapter touches on the value of mindfulness and self-awareness in recognizing when emotions are influencing decisions. By catching emotional reactions early, investors can pause and reconsider before acting. Finally, Berube stresses that psychological mastery is an ongoing process. Even experienced investors face emotional challenges, but those who keep their feelings in check tend to outperform others consistently. In essence, Chapter 6 teaches that success in investing is as much about managing your mind as managing your money. Developing the right psychology can protect your capital, enhance decision-making, and increase your chances of achieving long-term financial goals. Chapter 7. The Importance of Diversification. In Chapter 7, Nicholas Berube discusses one of the fundamental principles of investing: diversification. He explains that spreading your investments across different assets, industries, and regions is crucial to managing risk and protecting your portfolio from major losses. Berube begins by illustrating how putting all your money into a single stock or sector can be extremely risky. If that one investment performs poorly, it can significantly damage your overall portfolio. Diversification helps reduce this risk by ensuring that poor performance in one area is balanced by better results elsewhere. The chapter highlights that diversification is not just about holding many investments, but about choosing assets that behave differently under various market conditions. This means mixing stocks, bonds, real estate, and other assets that don't move in perfect sync, thereby smoothing returns over time. Berube also explains that diversification can protect against unpredictable events, like economic downturns, political crises, or industry disruptions that can disproportionately affect certain investments. By owning a range of assets, you're less vulnerable to any single shock. Another important point is the balance between diversification and focus. While spreading out reduces risk, over-diversification can dilute potential gains. The chapter advises finding a middle ground: enough diversity to manage risk, but enough focus to benefit from your best ideas. Berube introduces the concept of asset allocation as a strategic way to implement diversification. This means deciding what percentage of your portfolio to put into various asset classes based on your risk tolerance, time horizon, and investment goals. The chapter also discusses diversification within stocks, across sectors like technology, healthcare, consumer goods, and geographically, by investing in domestic and international markets. This global diversification can add another layer of protection. Berube warns that diversification is not a guarantee against losses, but a tool to manage and reduce risk. He stresses that it must be combined with proper research, disciplined investing, and regular portfolio reviews. In conclusion, Chapter 7 reinforces that diversification is essential for long-term investing success. It helps investors navigate market ups and downs with less stress and more stability, making it a cornerstone for building wealth safely on the journey from zero to millionaire. Chapter 8. Index Funds and ETFs. In Chapter 8, Nicholas Berube introduces two popular and powerful investment vehicles: index funds and exchange-traded funds, ETFs. He explains why these tools are often recommended for both beginner and experienced investors seeking a simple, cost-effective way to build wealth. Berube starts by defining index funds as mutual funds designed to replicate the performance of a specific market index, such as the S&P 500. Instead of trying to pick individual winning stocks, index funds invest in all or most of the companies within the index, providing broad market exposure. Similarly, ETFs are funds traded on stock exchanges, much like individual stocks, but they also track market indexes or sectors. ETFs offer flexibility of buying and selling throughout the trading day with typically lower fees than actively managed funds. The chapter emphasizes the advantages of these funds. Low costs. Because they are passively managed, index funds and ETFs have much lower expense ratios compared to actively managed funds. Lower fees mean more of your money stays invested and compounds over time. Diversification. Investing in these funds gives exposure to hundreds or thousands of companies, reducing the risk associated with individual stocks. Simplicity. For investors who don't want to spend time researching and picking stocks, index funds and ETFs offer an easy way to participate in the market's long-term growth. Berube also explains how these funds outperform many actively managed funds over the long run, citing studies that show most active managers fail to beat their benchmark indexes after fees. The chapter covers practical advice on how to incorporate index funds and ETFs into your portfolio based on your risk tolerance and goals. He suggests starting with broad market funds and gradually diversifying into international or sector-specific funds if desired. Additionally, Berube cautions investors to be aware of tracking error, how closely the fund follows the index, and liquidity when choosing ETFs. It's also important to invest with a long-term perspective rather than trying to time the market. Finally, the chapter encourages readers to embrace these funds as foundational building blocks of a sound investment strategy that aligns perfectly with the book's overall message: growing wealth steadily and reliably from zero to millionaire status. Chapter 9. The Role of Real Estate. In Chapter 9, Nicholas Berube explores the role of real estate as a valuable asset class for building wealth and achieving financial independence. He explains how real estate investing can complement stocks and bonds, offering unique benefits and diversifying an investment portfolio. Berube begins by highlighting the tangible nature of real estate. Unlike stocks or bonds, real estate involves owning physical property, such as residential homes, commercial buildings, or land. This tangibility often provides a sense of security and control for investors. The chapter explains several ways investors can profit from real estate. Rental income. Owning rental properties can generate steady cash flow through monthly rent payments. This income can help cover expenses and even provide passive income. Appreciation. Over time, property values tend to increase, allowing investors to build equity and sell at a profit. Tax advantages. Real estate offers potential tax benefits, such as deductions for mortgage interest, property taxes, and depreciation, which can reduce taxable income. Berube also discusses different types of real estate investments, from directly owning and managing rental properties to more passive options like real estate investment trust REITs, which allow investors to buy shares in portfolios of real estate assets. The chapter stresses the importance of due diligence when investing in real estate. This includes evaluating location, property condition, market trends, and financing terms to minimize risks. While real estate can be a powerful wealth-building tool, Berube points out the challenges. It often requires significant capital upfront, ongoing management or maintenance, and can be less liquid than stocks or bonds. Diversification is a key theme. Including real estate in a portfolio can reduce overall risk because real estate markets don't always move in tandem with stock markets. Finally, Berube encourages investors to consider their personal financial situation, goals, and risk tolerance before jumping into real estate. When approached thoughtfully, real estate can provide a steady income stream, capital growth, and valuable portfolio diversification on a path from zero to millionaire. Thanks for watching. If you found this breakdown of real estate's role in building wealth valuable, hit that like button and subscribe to Read Glow for more no-nonsense financial wisdom. Drop a comment below if you're thinking about investing in real estate or have questions. I love hearing from you. Remember, your millionaire journey starts with the right knowledge and smart action. See you in the next video.